Good evening, everyone. Welcome to my personal finances podcast, 5. Today, we're going to have a chat with Chris from New York. He's the author of 100 Baggers, Stocks That Return 100 to 1, and How to Find Them. Let's welcome Chris to the show. Hi, Chris.
Thank you. Thank you, Catherine. Good to be on with you.
For the benefit of our audience, could you please briefly introduce yourself?
Sure. Yeah. My name's Chris Meyer, and today I run a private investment partnership called Woodlock House Family Capital. I write a blog occasionally. If you Google it, you can find it. And before that, I worked a little bit with the Bonner Family Office. And then before that, for about 12 years, I wrote financial newsletters. And I've written 4 books. And 100 Baggers is the third one, based on a study that I did starting in 2014.
Very interesting background. So first, let's start with what inspired you to write 100 Baggers?
Yeah. Well, I got there's an investor here in the U.S. named Chuck Akre. He's an excellent investor, and he gave a speech once where he mentioned this book that really helped him. It's called 100 to 1 in the Stock Market by Thomas Phelps. And it came out in 1972. And that book had a study of all the stocks that had returned at least 100 to 1 from like 1932 to up to the date of the book. And I love that book. It's very quotable. Phelps is a good writer. And I used to write about it and quote it. And then a reader of mine actually once said, you should update it. And I thought, wow, that's a good idea. So that's how the ball got rolling. And the hard part was putting together all the data and the research. But that's what got it started.
That's definitely an interesting start. So were there any surprises or key challenges while researching and writing this book?
Yeah. Well, the big challenge was dealing with the massive data. I worked with one analyst, and we were able to go back to 1962, and it's just a lot of financial data. It's a very large database, and then we sort of weaned it down a little bit by taking out some of the tiniest companies, and we made some adjustments. But so working with all that data was a challenge, and then the surprise might have been, well, there were a number of surprises, but, one of them was that there are a lot of different ways up the mountain, so to speak. And there wasn't necessarily one way, or it wasn't any sort of, there wasn't sort of a magic formula that you could come up with. There are a lot of different paths to becoming a 100 bagger. And I think another surprise was that there wasn't any particular industry that dominated. When I started this project, a lot of people thought it would be full of tech stocks, for example. And it wasn't really the case. The list was made up of a lot of old economy stocks and companies that do consumer businesses like Home Depot or Coca-Cola, or their banks, their railroads. There's just all kinds of businesses. So the diversity of the list was a surprise.
Were there any particular sectors that, even though it's so diverse, were there any ones that, really feel at being 100 baggers?
Not really, no. I mean, there wasn't any. I think there were more important things were to start small, and there are other factors, which I guess we can talk about later, but there are other factors that were more important and predictive than industry. Industry really doesn't matter. So I always tell people, when they say, what industry should I look for 100 baggers, and that's really probably not the best filter.
So could you give us an overview of the essential principles of finding the 100 baggers?
Yeah. Well, I think from doing the study, there are definitely some things that stand out. And one is you need a lot of growth. So you want to find companies that you can imagine them being a lot bigger, a decade, 2 decades out. So you need growth. And 2, if you think about it, you need to have a pretty good competitive position. So if you're going to survive all that time and do well all that time, you need to have, what we usually call a moat, where you need to have something that you do that's special that competitors find hard to replicate or compete with. I think probably the most important principle And if I had to rewrite the book today, I would emphasize this even more. But probably the most important principle is to earn a high return on the capital invested in the business. So there's lots of different ways you could measure it. You can look at return on assets and return on invested capital, return on capital employed. These are all sort of words you could Google and get definitions for. But the basic idea is you want to find a business that, in simple terms, if you invest $100 in capital in that business, it returns a high number, say $20. And then the second important piece of that is it has to have the ability to reinvest it and earn that return again and again and again. So you want that high return on capital and the ability to reinvest it again and again. And at that point, it's just a math problem, because to get to 100 return, a 20% return reinvested over 25 years is 100x, or 25 over 20. So it becomes a math problem. Then the higher you go, the shorter time it takes. But those are really the kind of the most important elements that I found.
One of the interesting things I found as when I was reading through your book as well was that it's not necessarily very tiny companies or even penny stocks. So maybe could you elaborate a little bit more from that aspect?
Yeah, in fact, one of the things I did in the study was to screen out a lot of the little penny stocks, because there are a number of stocks like, little junior miners that trade for 13 cents, and then they spiked up on some news, and the reason I took those out is because I really wanted to try to find a way that people could predict with some reasonable, some reasonableness, that they could predict what might return 100 to 1. And then those kind of stocks, like little penny medical stocks and penny those very speculative stocks, are very hard for anybody to know unless you're on the inside somehow, or you have some sort of inside knowledge of the company. The ones I focused on were the ones where you could look at the financial footprint, so to speak. You could look at their financials, and you could look for the kinds of things that I'm talking about, like the high return on capital. And so once I screened that out, I found that the median size was about $300 million, and these are reasonably substantial businesses that had good sales. And so you don't need to, focus on these tiny companies. Most of the companies in the study were pretty substantial businesses at the start of their run.
You mentioned the time frame as well. Is there like a minimum duration that you screen for, say 5 years or even 10 years?
No minimum duration. I mean, I spread it out, and it kind of formed a little bit of a bell curve. So most of the names kind of fell in that 20 to 25 years is what it took. But then you could come out, and there's a reasonable amount of names that did it in, let's say, 10 to 15. And so, yeah, I think, the other essential element that I should add to this is that you do need time. The approach I'm focusing on in the book, when you're looking at these return on capital and the ability to invest, those two things, the third element is then you need time. So you need some time for these things to unfold, and you need to be patient. That's another important message in the book.
Interesting. Right. So the next question, I'm pretty sure it's a question that most Malaysians would want to know. So which is, do you see any potential 100 baggers on Bursa Malaysia?
Yeah. Well, I don't see why not. I mean, in the book, I reference a study on India, and there's lots of 100 baggers that have occurred, in India over the last 30, 40, 50 years. And I know there are 100 baggers in other markets. Since I wrote the book, I've got a lot of anecdotes. People send in stories from other markets of great companies, in UK or France or other markets around the world. I'm sure that there'll be plenty of 100 baggers that emerge from China. And I kind of hope that somebody will maybe try to do the 100 bagger study again, but do it for a different market. Like maybe do one, focused on Asia or focused on Europe, or and see if some of the lessons are the same. I suspect they will be. So yeah, I think that there certainly are. I'm guessing there surely are 100 baggers in Malaysian stock market somewhere.
Yeah, that definitely will be interesting. Looking at how the growth is in Asia, etc.
Yeah.
So, Chris, so what are the next book and projects you are actually working on right now?
Well, I don't really have any book projects next coming up. So I've had a lot of people like me to update 100 baggers because the study ends in 2014. And that's, possibility. It's a lot of work, but maybe that's a possibility. But otherwise, I don't have any book projects right now. I just focus on managing my fund. And like I say, occasionally we'll post blog research. And a lot of that has to do with 100 bagger style investing and different case studies and things that have appeared and other bits of information. So I don't know. No projects yet.
So it seems interesting because it would appear that you wrote a newsletter about 100 baggers for quite a while, and then that finally resulted in a book as well. Do you see any particular learnings that you're heading forward with?
Yeah, I mean, that was interesting writing the book that way because partly I got to test it out on different readers, and I was able to collect a lot of anecdotes from people who have had 100 baggers, and a lot of that is in the front of the book. And I like those stories too because they make it clear that really anybody can do this. I mean, you don't have to necessarily be a professional money manager. In fact, it might work to your advantage because as a private individual, you can just you can create your own little portfolio and you can leave it alone. You don't have to report quarterly to investors or worry about your performance over some short hurdle. You can't get fired. It's your own money, and so you can take some piece of it. Create a portfolio of maybe a dozen names that you think have a shot, and just leave them alone. So, it was interesting to do the whole project. It's been very interesting.
All right, definitely interesting as well. We have a few questions as well, so we'll go ahead and ask them here. And
this is the fun part. Fire away.
Yeah. All right. So our first question comes from Cassandra, and she's asking, out of all the 100 baggers that you've seen, which real life example is the one that just stands out to you?
That's a great question. I mean, there's a lot of them that I like, but one that comes to mind just because actually I don't know, this one's in the book and might not quite be a 100 bagger yet, but I like the example I always bring out is between Domino's and Google, because they both went public in the same year in 2004. And Domino's Pizza is actually a little ahead of Google, which surprises a lot of people. So that's one reason why I like that example, because also, it's counterintuitive, and it gets to the point that I mentioned earlier on that really, any industry you can get to 100x. It's not tech or anything like that. So Domino's Pizza, pretty simple business, right? Delivering pizzas, but it's an excellent business with really good economics. So that one stands out. I guess in the book, one that I kind of admire is Danaher, an industrial conglomerate that's been performing at a very high level for a very long time. And that's one that checks a lot of my boxes, and I'm sort of annoyed that I never owned it. It's
it's always the ones to get away, right?
Yeah. It's because they have the Rails brothers are the big insiders there, and I like that to have. I like to invest in companies where the insiders own a lot of stock, and they have this system that they've just created a machine, and it just continues to just pound out awesome returns year after year. So that's one I like also because it's a little surprising. It's an industrial company, and I imagine if you looked at it 10 years ago or 20, if you looked at it say 20 years ago or even earlier, it would have been difficult to say, wow, that's going to be 100x if you just thought about the business. But if you looked at the underlying economics, as I talked about, there's very high return on capital, and the ability they invested again and again and again and again year after year, and they got there.
Right. We also have another question from one of the viewers, which is there any specific quantitative techniques that we can apply to identify 100 baggers?
Right. I mean, this is what everybody wants. And this is what I wanted too, right? Is to be able to find a formula so we could all just run a screen with a few numbers and bang. And here we get our list of dozen names and we just go through them. But I would say no, that doesn't work out that way. In fact, probably the most important work that you'll do will be the qualitative stuff. But if I had to pick a quantitative variable to focus on, I would again focus on some aspect of that return. So, you can start with screens for either return on assets, return on equity, return on invested capital if you have that. Return on capital employed is another popular one, and screen based on that. And that's at least a start, because that gets you kind of thinking about the most important things. And then you can kind of look through more of the qualitative things. In the book, I talk about a number of those. I mean, you want to know, quality of the management team, right? You have to have people that are honest, that you feel will treat shareholders fairly. And you have to look at things like competitive position. Maybe a business might have a very weak competitive position, or there might be some threat looming out there. So you have to think about those things, because again, this is something you're going to want to hold for a long time. And you don't want to get into a situation, let's say if you're buying newspaper stocks 20 years ago, where you're facing a massive competitive threat with the internet. So, those are probably the most important quantitative ones, but the qualitative stuff is also very important.
Just now you mentioned on screeners as well. Are there like specific screeners, or do you need to build your own, or off the shelf or screeners that you find online? Are they sufficient for the average individual screening?
Yeah, I mean, you can. I don't know. There's some that are free, or they're not very, very expensive. I think there's a free screener at Yahoo. I think Morningstar has one. I mean, I use part of my investment partnership. I have Centio, which probably is going to be too expensive for most investors. Capital IQ is another one that's, but again, those are expensive. But I don't think you need an expensive screener. There's a lot of free ones, and again, you don't need that many names. You only need you don't need a lot. So, and you can take your time. You can sort through them, and you can read with this idea that you're looking for 100 baggers. So you pay attention to small companies that are doing interesting things. And it is tough to come up with ideas. I mean, it's not like these things are just lying around. But one of the things is that once you start looking for them, you can it focuses your attention a bit. So you're not going to spend time looking at some giant company that you might make 20 or 30% on. You're not going to look at like utility stocks. You're not going to look at, some of the deep cyclical stuff. You're going to start to focus on those things I talked about, and that's going to help you come up with some names.
Mm-hmm.
Of course, you also use things like Twitter. I mean, social media, Twitter, there's always interesting discussions about fast-growing companies doing interesting things. So, I mean, I think it's probably a good time to be an investor doing this now, because, I remember like before the internet even, I mean, I remember ordering annual reports and getting them by mail, and,
wow, that's really old school.
It's really, I remember going to the library and getting the, the value line pages, small cap value line, to see what was going on. So we have a lot more tools now than we did.
All right, so we have this question that's related as well, in a way. So how many stocks do you have to evaluate to arrive at just 100 bagger?
Yeah. Well, that would be, hopefully, you look at one and you get one, right? That's the ideal. But as a practical matter, you probably go through a lot of names. I mean, you're probably going to say no to most things. And it depends how many names depends really. That's a hard one to answer. You're going to have to look at a lot of names, I would say, before you find it. And then, I would say a lot of times other people ask me too, is how many stocks should they own for this? And so there are different strategies there. Some people like to, do the 1% in every name, and then they have a big portfolio and they just hope that one of those hits. But I prefer to do it more, or I do a little more work on each of the names, of course. And I think you could work it down to, 10 or less, or maybe a dozen. I mean, you only need a couple, right? So that gives you some idea. I mean, you got to look through a lot. You got to turn over a lot of rocks, as they say.
And you just need a few home runs, right?
That's right. You only need one. There's a saying, you only need to get rich once. It's kind of the, 100 bagger would be pretty significant for just about anybody.
Have from the audience.
Yeah.
Right. So we also have another question from the audience, which is how long is the gestation period for the company to reach its potential?
Mm-hmm. Well, it's going to be different for every company, and some companies takes years for them wandering around, before they figure it out. And some companies hit the ground running right away. You think about Facebook and Google and those companies, when they went public, they were pretty good businesses right out of the gate. And certain other businesses just took a lot longer to find their way. But I would say, again, not worry so much about the age of the company per se. You can pay attention to the returns that business is earning, and if they're earning high returns on capital and they seem to have the potential to continue to do it, then that's an interesting proposition. That's probably one that deserves more attention. And then again, you're going to have to hold it probably for a long time, and it depends on what kind of returns that business generates. But most of the stocks in the study fell somewhere in that 20 to 25 years. Although, you could probably raise the bar what you need, and you could probably get it down a little closer. But still, you're going to need. This is a long-term investing approach.
I saw some of the 100 baggers that were really short. I believe less than 5 years. Is that out of the ordinary?
Yeah, that's usually out of the ordinary. And to do that, you need some sort of crisis to help you out. So
we're in the right time right now.
Yeah, like 2008, you had, you could have picked up some things that would have certainly, the great bear market bottoms, 73, 74. Yeah, 2008. March this year, you had a chance of picking up some things that are really cheap. And probably already, some of those names are already, 3 or 4x. So, you need a little help if you're going to get it inside 5 years. Usually you need to have a really good entry price, and you get that when you have a big crisis.
So, So the next question is when to quit, and how do we know we haven't done?
That's a really good question, because that basically is the question of when to sell. And I always like to tell people that selling is the hardest thing to do in investing. Nobody's good at it. It's easier to buy. It's much tougher to sell. So I think for me, a good time to sell is when your initial thesis is no longer true. So you invested in something on a certain premise, and maybe let's just say that premise was that this business is going to be able to earn that 20% return on capital you're looking for. They have the ability to reinvest. They have good competitive position. They're growing. So you're going to hold as long as those things are true. And let's say 2 years, 3 years down the road, something happens that you couldn't anticipate, nobody could have guessed, and profitability of the firm is impacted in a permanent way. Like it's not going to be able to recover some structural reason. That would be a good reason to sell. It's because it's not what you originally thought. So in general, that's kind of how I think about it. When you're wrong is a good reason to sell. And that, it's easy to talk about when you're wrong. When you're really doing it, it's tougher because we can always talk ourselves, into believing almost anything we want, right? So this is where I think it's also helpful to write things down. Like I keep an investment journal myself, and then for every stock I buy, I have a memo where I write down why I'm buying it and be very specific, and then I update it. And that way you have a real record of your thoughts. And if you wrote something back here and it's no longer true, that's a pretty good flag. So I think those are some helpful tools with how to sell. What I wouldn't do is, don't sell because the price falls, or don't sell because the price goes up. I mean, a lot of people want to sell based on what the price action is. And, you can be successful doing that. People have made money being traders, sure. But for this particular style of investing, looking for those 100 baggers, you need to be able to sit. And so you're going to have to suffer some drawdowns. I talk about in the book that Berkshire Hathaway, which was the best performing stock in the study, was cut in half 3 different times. And that wasn't even the worst. I mean, even if you look at companies like Amazon had an 80% drawdown. And even, Monster Beverage is another favorite because it turned 100x relatively quickly. I think it was about a 10-year time frame. It had multiple times where the drawdown on the stock price was 40% in a month. So think about what a mistake it would have been to, panic out and sell then. So yeah, you need to be able to sit still most of the time. Be a reluctant seller is the way I like to tell people. So if you do all the work on the in the beginning, then you'd be very reluctant to let it go.
How about on the other end though? So let's say it's made quite massive gains, and you feel that it's already overpriced at this stage, but say it hasn't quite reached 100 bagger stage yet. Should you take some portion of profit at that point of time?
Well, I mean, some of it's going to be your personal preference. I mean, if it gets to be so it's a big portion of your portfolio, it makes you nervous, maybe you should cut down a little. But in general, again, with 100 baggers, you're going to have to learn to live with a stock that's overpriced, and you're going to have to let it get overpriced. And that's one other interesting thing about these is that a lot of these 100 baggers were, they looked expensive for most of their life. They looked overpriced. If you think about it just intuitively, the best stocks are going to spend most of their time near 52-week highs. It's just the way it is. If they're going up and up and up, they're always going to be, near their highs, and often they're going to look expensive because these are great businesses. And it's not a mystery after a certain point that a McDonald's or a Microsoft or a Home Depot is a great business, and you're going to have to just pay up if you want to own it. So this is another thing that, in the book I talk about, valuation is important. You prefer to buy something cheaper. And I think, that's obviously definitely true. You prefer it. But again, if you're a long-term investor, they're going to be, if you buy one of these businesses that are really high quality, you can afford to pay up a little bit. Your margin of safety is in that quality and in that growth, and you always have chances to buy it again. So say you buy a position today, and then it turns out, you overpaid a little bit, and then 2 years later you can get a little cheaper. Well, then you can buy more at that, more then. So I think you gotta let your stocks have a little bit of room. You got to give them a little bit of a leash. You got to let them disappoint you a little bit, because there are going to be quarters where they have bad quarters, and you're going to have to sit through those. But you're also on the other side, you're going to have to let the stock, get ahead of itself sometimes. And you're going to have to be resilient enough just to wait it out.
Thanks for sharing that, Chris.
Yeah, sure. That's good questions.
So the next question from Lynette is, do you see any potential during this pandemic, and why?
Yeah. Well, I mean, the pandemic is kind of the big macro event for us, for sure, isn't it? When I look back at the past 100 baggers, there's always some big event happening somewhere. So, whether it's a stock market crash, or whether there's oil crisis or a war, or there's some inflations, or there's always something going on in the backdrop. I would think that it's probably best to not pay too much attention to that as a long-term investor, because the pandemic creates certain short-term winners for sure, and there are short-term losers, but it's not going to be with us forever. So, and your holding period as an investor is going to extend well beyond the virus. So I don't think you want to pay too much attention. I mean, I think the virus creates interesting opportunities in travel-related names. This might be a chance for you to get a really good price. It's at one of those travel names, or perhaps something involved in aviation, or maybe there's even high quality restaurant franchise that's particularly hit hard by the virus that you're sure is going to be able to survive and will revert back to form over the next 2 or 3 years. So yeah, I think there's probably some opportunities, but I wouldn't overweight it too much. Keep your focus on what's going to happen years and years from now, even beyond the pandemic.
Yeah, really good to keep a longer term focus as well.
Yeah.
One of the interesting things, and I love coffee as well. I drink at least a couple of cups of coffee every day. Can you share a little bit on the coffee can approach that you talk about quite a bit?
Yeah, the coffee can is one of my favorite ideas. So that's it comes from a money manager named Robert Kirby, and he wrote an article in the Journal of Portfolio Management in 1984. It was called The Coffee Can, and the basic idea of the coffee can, they see in the old West in the U.S., they would people would take their valuables and stuff them in the coffee can and then kind of hide it, So it was a way to hide your valuables and kind of leave them alone. And so he took that idea and applied it to stocks and thought, well, if you could build a portfolio and you call it your coffee can portfolio, you leave it alone, you would get good results. And that it grew out of a personal experience he had where he was managing a client's account. It was this woman, and he's managing the account, buying stocks and adding and trimming and selling and doing all the things money managers do. And then her husband dies, and then she brings him her husband's account, so he manages that account. But then he realizes when he looks at that account that the husband had been piggybacking on all his recommendations in the wife's account. So he's been kind of trading behind it, but with one difference is that he would buy things and he would just leave them alone. And so what Kirby found when he looked at the husband's portfolio is that, he had some of these positions had grown to enormous size and some of them had declined. And, one of the positions had grown bigger than the entire value of the wife's portfolio. So he thought to himself, wow, there's a lesson in that. Here he was managing this, making all these changes, and he would have been better off if everything he bought, he just left it alone. And that's where he got the inspiration for the coffee can. So I think it's an interesting kind of practical way that an individual can learn, or it's kind of like a crutch to help an individual investor hold on to their stocks longer. You take some piece of your money and you create this coffee can portfolio that you're going to leave alone, for 10 years is what I say. So you put, maybe 5, 10 stocks, whatever it is you want to put in this coffee can portfolio, and you just leave it alone. And you have another account maybe where you scratch your itch to trade stocks or whatever, but you leave this part alone. And so, I think that's a good idea. And there have been a number of sort of real life coffee can portfolios over time. I'm on Twitter, and a friend of mine, John Boyer at Boyer Capital Management, they put together a portfolio 10 years ago, and then they just got the results now. And it was very similar to Kirby's experience. They had one big winner and they had a couple others that did very well, a couple of losers, but the overall return easily beat the market.
Definitely interesting. For Malaysian approach, we'll probably call it our Milotin approach. But that's the same concept, definitely.
Same idea.
Yeah.
All right. The next question that we have is it always advantageous to look for stocks with buybacks?
Is it always? No. Some companies are very bad at buybacks, and they buy back their stock when it's high, and then when things are low, then they don't do it. I think that how they do the buybacks is important. I think, I have a chapter on buybacks because there are a couple of interesting cases where stocks that have businesses that are good, but they don't necessarily have that ability to reinvest, have still become big winners because they just took that cash and they bought back their own stock. And so we have a word for them. We call them cannibals. They just kind of eat their own. And I think the example I used in the book was AutoNation, which when you look at it as a business over whatever it was, a 20-year stretch, the business wasn't that much bigger. It wasn't like it was a high growth name, but because they bought back so much of their stock, your overall return was fantastic. So a buyback is an interesting tool. It's a way to sort of accelerate returns. And I would definitely prefer a company that keeps its share count relatively flat or declining over time than ones that let it grow. But there are always exceptions. There are always exceptions to these rules. So, to answer the question, not always, but it's buybacks are a helpful tool.
On that tangent as well, how about stocks that declare dividends or stocks that don't? As Berkshire.
Yeah, dividends is one of the more controversial conclusions. And Thomas Phelps came to the same conclusion. In fact, he says in his book that dividends are an expensive luxury because if you think about it, if you want to buy a business that takes all of its cash, reinvests it, and gets that high return again and again, well, any dividend is like a leak in that process because then they're taking their money and they're putting some out to shareholders and then they're reinvesting less than they might otherwise. So that's the point he was making. And again, if you're really this particular style, if you're looking for those 100-bagger stocks, you don't really want a dividend. You want them to be able to reinvest all the money. But that's not to say dividends aren't an important factor in returns. But for this particular style, you don't really want a company to pay you a dividend. You want them to reinvest it.
Definitely for the growth.
Yeah. Next question we have is, what would be your advice for any aspiring authors?
Aspiring authors? That's an interesting question. Well, I'd say, I always tell people, they say they like to, they want to write. How do they get started? Well, the first thing, is to write. And you have so many outlets now. So even if you just create a blog that hardly anybody reads, or, just keep writing and getting feedback, and you get better just by repetition. So that's one thing. And then if you're an aspiring author, like you have today, you have so many different ways to get published and get noticed. It's really, it's a great time to be an author. If you could put together your own book, you get it self-published, you could pass it around, and then you could pick up a publisher that way. So that's an avenue that wasn't available before. But I would say, another thing I would say is, don't go into it because you think you're going to make a lot of money.
It's not true. Yes.
No, there's not a lot of money in books. Do it because you really have something you want to say, that you want to do it because you have to do it. It's like you feel this need to express these ideas, get these ideas out, and that's the most satisfying thing. And to make a lot of money in books, you got to be like I don't know, J.K. Rowling or John Grisham, and sell like millions and millions of copies. And I guess it could happen, but for most people, your book's not going to make you a lot of money, but it's a very intellectually rewarding exercise. And if you're in business, I tell people it's an expensive business card. It's it opens a lot of doors. It helps you meet a lot of people. I get to meet you guys. Would have never met you if I didn't write the book. And there's lots of people I've met along the way that I would never have met without the book. So there's lots of good reasons to do one.
Most definitely, very good personal advice for us as well, as we are also in the midst of publishing for My Personal Finances as well.
Yeah.
Mm-hmm. Right, that's some really good advice. So to conclude this, what is that one big audacious habit or goal that you want our audience to take action right now?
I would say for them, their big audacious goal is go ahead and create a list, find three names that they think could possibly be a 100-bagger. And, go ahead and create that portfolio. You start with a small amount of money, just to test it out if you want. And, but that's your goal. Come up with three stocks you think can be 100x, and start creating that portfolio.
That's good. All right.
Okay.
If not, thank you so much, Chris, for spending this time, calling in with us. And I'm sure our audience greatly benefited from your sharing and advice today.
I hope so. And thank you both for having me on. I appreciate it. It was a fun conversation and lots of good questions.
All right. So do pick up the book if you have yet to. 100 Baggers by Chris Meyer is available in all the popular bookstores here as well. So do definitely look out for it.
Thank you, Chris.
All right. Thank you, Catherine. Thank you, Steve. It was fun to do.
Hi, thanks everyone for watching. I really hope you enjoyed learning from Chris. I think he really gave some good advice. Best thing that I learned from him today is really why not just start with a really small portfolio, start with just some amount that you are comfortable with, pick 3 stocks and start building it from there. And so thank you all for listening again. And you can find the show notes and links on our website, mypf.my/podcat. I'll see you next week, and don't forget to subscribe. Bye. Hasta pronto.